Well, good morning, everyone. Thank you all so much for coming again to be a part of the financial literacy. Always new and different information, always new and different people. So for you all that are first timers, and if you need a book, let us know. I think I don't see anybody here for the first time. I think I got everybody. I got 6 people, is that correct?
Let's see here. Yes.
Yeah, so I think no one's here new, so I think that should be everybody that's been before and should have a book already. So we'll go ahead and get started. We have Deacon Moore lead us this morning in a word of prayer.
Well, I'll tell you what, since we have the illustrious Deacon Gaynor
I thought about him.
on the call, why don't we have him to lead us here?
We sure will.
Okay, let's bow our heads. Most gracious Heavenly Father, we thank you for another beautiful day, and the sun is coming out, and Lord, we just give you all the praise and honor. Lord, in spite of what all we're going through, Lord, but I know you're still in the midst, and Lord, you lead and touch each family that's going through some trials and tribulation and suffering. But dear Lord, we just thank you for this time we can come together to study about financial business, because Lord, sometimes we can go astray, and we need some guidance, and we just thank you for Sister Beverly and Deacon Moore to bring, Les Moore to bring this to us, Lord, because Lord, we, even though it's yours, but you have put us here to be partakers over it and do your will. And yes. Lord, I pray, Lord, you'll touch each one of us, Lord, and open our hearts and our eyes to whatever's going to be said today, Lord, that it may meditate upon our hearts and strengthen us. Lord, be with those afflicted with sickness and illness, those who cannot be with us today, Lord. Be with them where they are. Well, bless this time, and we ever give you the honor and all the praise. In Jesus' name we pray. Amen.
Amen.
Amen. All right, we'll just start with a couple of housekeeping items. This is very informal, so this is for us. Anyone that have any suggestions, some questions, anything that you want to add in this morning, just feel free. We have a small group, so you can even just verbally say that. But if you have a private question that you might need an answer to, feel free just to send that over to myself or Deacon Moore. All right, Deacon Moore, if you could put up our presentation, please. All right, so can everybody see that okay?
And again, I want to point out that if you want your own copy, there's a copy on the website. Just scroll down there. You can see where it says click here, and you can get your own copy.
Thank you. So today we're on our 4th session, and so we're today via the Zoom, and we're thankful for that as well. Thank God for all things, right? All right, next slide.
Hang on here.
Okay.
Let me stop. For some reason, it doesn't want to go forward here. Let me share this one instead, and my apologies.
That's okay.
Had it in presentation mode, but it didn't want to move. My system here seems to be locking up. Yeah, there we go. I'll just do it like this. My apologies.
Okay, so for those of us that's been here before, we know that this information is put out by the Financial Protection Bureau out of Washington, and they designed this information for community use, and the only thing they want us to share with you for sure is that they don't warrant anything. They just let you know that the information is provided. We tweak these I tweak the material, so I use part of what they give me, and then I use some additional information to bring in to us. So they just want to put a disclaimer out there that in case I say something that's legally wrong, that they're not held accountable. Next slide. So today we will just kind of follow this simple agenda that we have. We're not going to go over sessions 1, 2, and 3 in details. We have that available if anyone needs additional information that's new for the first time. So we're going to discuss managing your finances during the COVID-19. We're briefly. Uh-oh, everybody muted. Okay. We'll briefly discuss and review the goals from our last sessions. We did a personal goal, and we talked about a financial goal or emergency fund goal. We will review our third biblical principle. We'll discuss a long-term goal of becoming financially empowered. And I always like to present that one because that's kind of our mission, where we're going, where we like to be at the end of all of our sessions that we'll go through. We will review our fourth biblical principle. Take that third one out. Now we've already talked about that. We'll discuss dealing with debt. That'll be from our module 6 in the notebooks. We'll discuss understanding your credit reports, and your credit scores. And that's in module 7. And then at the end, if we have time, we'll review a disaster checklist.
One bit of housekeeping. I'm going to put everyone on mute because there's some background noise, but you have the ability to unmute yourself if you have a question, okay? But just to make sure there's no background noise, I'm going to mute everyone, but you can unmute yourself. Miss Beverly, hold 1 second because I'm going to mute you, then unmute you. Go ahead, Miss Beverly.
All right, next slide, please. Okay, so managing your finances during COVID-19. So we looked at a couple of different things in our previous section, and I brought a couple of those back, and I've added a couple of new items here. So it's always important, no matter what time of life and season we're in, to live on a budget. That's really, really important during this season. So you want to review and revise your budgets as needed and be very conservative during this point in time, making sure that you're tightening up your dollars a little bit. You want to also know that this could be some very unknown things ahead of us, so we don't know. So that's why we want to be a little bit more lean and efficient and try to save when we can. You want to prioritize your bills. You pay your essential bills first. You want to contact your creditors for payment plans or hardship options. A lot of the credit card companies, mortgage companies, they're doing some options right now to address some particular needs that people may have regarding their payments. You also want to apply for unemployment if your job was lost due to the virus or due to a furlough from your company during this time, because they're giving additional monies as well, up to about $600 per week for those that have to file unemployment. And that website and phone number is listed below. And Deacon Moore, can we go to presentation mode so I don't have to put my glasses on?
I put it a minute ago. For some reason, I couldn't fast forward, but let's know. Hang on, give me 1 second.
Okay.
Here.
I feel like I'm squinting my eyes here.
It's working now. Great.
Oh, there you go. Okay.
Is that better?
Thank you. Much better. All right. So we I also want to talk a little bit about the stimulus relief refund money. Some of you might have already received your money, and so be very wise with that money as well. So you want to be able to pay off debts and manage your budget right now as well. But try to save any of that money that may come to you, because we're just not certain of a lot of things that is coming ahead. Major employers are continuing to lay off. University of Kentucky is starting their cut. So we just don't know at what point things may change for us. All right, so if you can cut any non-essential expenses that you may have, such as unnecessary subscriptions to magazines and different clubs, and maybe your gym membership for right now, just to kind of save a little extra money. And you can also downgrade non-essential, uncuttable expenses, such as maybe your cable bill or your internet service or your, so definitely a cable bill. You can always squeeze out some extra money there. We've been able to do that a couple of times in the past. You want to learn how to do many of your own home repairs. There's some very good do-it-yourself videos out on YouTube that will be able to help you learn some new skills during this time. And if you are employed or working from home, this is also a great time to get some additional online certifications or training to enhance your job knowledge. And this will also prepare you for when maybe the job market opens back up. Maybe your job won't be available anymore. But what are some new skills that you have after COVID-19? Anybody have any questions on any of those? Okay, next. And also note that up there in the top, I didn't mention that, go back one moment please, that the link to the COVID-19, if you are trying to find out where your payment is, then you would want to definitely go there, and it'll kind of give you an idea about your payment. Next
I'm
one.
assuming you're speaking now of the tax refund?
The tax refund, that's stimulus refund.
Yes, stimulus, I'm sorry, yes.
The stimulus refund. All right.
Okay, I'm assuming that I need to cover the biblical principles that we've covered already. If you've been in
Well,
the
we're doing number 3 right here. Oh, yeah, okay.
Right.
Oh, that's 3, okay, go ahead.
Okay, well, if you only want to cover what I covered last month, I'll just cover the whole slide here, because this will be very quickly. The biblical principles we've covered to date have been, in the first meeting we covered, God is the source. And the point, and I think that Brother Gator made that point in his prayer, is that we need to understand that all the gifts we have come from the Lord. If we understand that God has made us stewards of those things, then I think that would help us as we make decisions. The second one is that giving is essential. We covered that in the second meeting. We're supposed to honor the Lord with what he's given us. You may remember the whole point of the parable of the talents was that, the people who used the talents given to them by God were blessed. The folks who hid their talents were not blessed. In Luke 6:38, it also says, give and it should be given unto you, a good measure, pressed down, shaken together, and running over. The point is that God expects us to use our gifts to glorify him and to bless others. In the last meeting, we actually covered 2 principles. One was live on the margin. The other one was savings. I put those 2 together because I thought they went well together. In Psalms 22:3, it says, a prudent man foresees, but a foolish man goes ahead and is harmed because of that. So the point is that if we live in a world where we're just living check to check and not understanding that it is a known fact that stuff is going to happen, your car is going to break down, something is going to happen. To live as if that word doesn't exist is really foolish. So you ought to be putting something aside. You ought to be living off less than you make. Because when tough times come, you have a means to provide for yourself. The Bible says the man that doesn't take care of his family is less than an unbeliever. So it is our job as men, as Christian men and women, to make sure that we're doing things for the future to provide for ourselves. The 4th principle was saving. As you live on that margin, have some savings there. There's treasure in the dwelling of the wise, but the foolish man spends it all up. And is what Psalms 21:20 says. It is a very important thing that we have some savings there for when those times come. And that's why I put those 2 together. As we live on that margin, we should save that difference for those tough times. Amen.
Thank you. Okay, so now we'll move on to reviewing the personal and financial goals. You may have your handouts from last time, so we'll just go over this kind of real briefly, but it's very important that we do set goals. I know oftentimes if that's not a habit, it can sometimes take a while to get in the practice of setting goals. They don't have to be laid out and massive, but as long as you're putting something down in writing so that you know, hey, here's where I'm headed. I have a plan. This is my map. This is the pathway to some things that I want to make sure that happens in my life. Next slide. Okay, we talked about in the past that as we set goals, they should be SMART goals. These goals should be specific, should be measurable, should be achievable, should be relevant, and they should be time bound, meaning that you set a specific time for that particular goal. Okay, so you should have that handout from last time. So we're just going to talk briefly, what are those key components to putting that goal in place? So as you go down to the little box on the bottom, my SMART goal. So this goal is in reference to any particular goal that you want to set for yourself. That goal could be, I want to take a vacation after COVID-19. So that might be your goal. So you start your plan. So that will be my SMART goal. So then you follow steps number 1 through 4 at the bottom. So this is when you put the meat into your goal. You have to have action. If there's no action to your goal, then it just becomes a dream or a desire that you have, but not anything that would take place. Because at the end, that may cost you $1,500 for that vacation. But if you haven't put the money together, then you may not be ready to make that happen. So always put the action into your goal. So that's the number 1. So we'll go back a slide. Okay, and then the resources, what will I need to make this goal happen? So you have to put it down. You have to be very specific. How much money, what am I gonna need to make that happen? And the date that you wanna have that done by. So, oh, I wanna be sure to be out by the fall. Not sure what the things are gonna look like, but maybe by October I can have this vacation plan. What am I gonna need? And then in the last column, you wanna make sure that you're discussing that with somebody, because sometimes that person can hold you accountable. Did you put that money aside for that goal? Did you make that reservation? You know, did you check on, you know, the meal plan or whatever that you need, so that you're ready at the end of that specified amount of time to be ready to make that vacation come true. Next slide. So also, as we know, in life, things do change. So you always have to be open-minded. You might have had a vacation already planned, maybe for the spring. So which means that now you have to go and revise those goals. And some of the reasons that you have to do that, circumstances have changed. You can't make your weekly savings goals. You used up your emergency savings, so you didn't put back the money that you hoped to put to that vacation, or your goals don't feel so important anymore. So right now, that spring vacation may be still important, but may not be practical for right now. Next slide. All right, so things, here's some steps to take to creating those savings goals. So we're talking now about the savings goals. Like I had something on my screen. I need to move up my little pictures here so I can see. All right, so taking steps to create that savings. So you must make that decision to save, and you have to be committed to it. Commitment is so necessary, even if it's a small amount that you're saving. But don't go week to week if you have a goal to save. And I think we should all have a goal to save, as shared already earlier. But if it's only $20, if it's $15, it's $50. And right now, I know many of us are saving on gasoline. We're not driving as often. Our car insurance is going to give us maybe a credit for not using our vehicles as much. That's, you know, the stimulus check. There's all kinds of little things that we may now, entertainment dollars have been probably decreased. So that's maybe some extra money. So you want to revise even the budgets that we did in our earlier sessions to see, okay, now is there some options to save a little bit more money. Also, there are 2 ways to find that money to save. Always we can spend less is always number 1. If we're able to do that, we can earn more. So when we talk about the earning more, even now in this down market, I know that, you know, I'm out on LinkedIn, I'm out on Indeed, and I always see, you know, opportunities, but now's a good time to put yourself in place to, oh, there are jobs. I can earn more, but what am I going to have to be able to be that person that get the job when so many are going to be looking? The job market's going to come back someday, but the competition is going to be very keen. So you want to make sure that you have everything in place so that you be able to be considered for those opportunities. Working a second job, again, is an option, going back to those employment options. Overtime. Now, that may not be as prevalent in some areas, but I know there's still people. My friend works for the unemployment office. She's getting all the overtime that she wants. There are bonuses, the tax refund money, stimulus relief money. So there's all kind of ways to kind of look and see if you can pull a little money from any of those categories. So if you're paid bi-weekly, there are 2 times a year that you get 3 checks. So you can also look at saving those extra 2 checks. Next. Okay, so we talked about creating an emergency savings plan. So similar to what we talked about just when we were talking about that vacation goal. So just making sure that you specify what it is you're doing and putting the action in hand. So we look down at the bottom where it talks about we're saving now for the emergency fund. So for those of you that may not have done this already, it's not too late. So this emergency fund goal, you know, everybody should have at least $500, you know, in the next 6 months, if that's possible. So what you would do, you would just take that 500, that's the amount you want to save. Your time frame is 6 months. And then you just divide it by the month. So we're going to divide it by 6. We end up with $83.33 per month. And if you're paid bi-weekly, that's looking like $41.67 per check. So I think, you know, you can maybe look in your budget and see if that's possible, because as we talked about before, there's a great deal of people that don't have $400 for an emergency. So if we could start with this $500, and then once you reach that goal, you can continue. You don't have to stop at the 500. You know, you can continue that savings, and you can continue making another goal and splitting the money up later. Anybody have any questions on that? Next slide.
Well, I want to add now, not only can you probably continue on past 500, you actually should, because the goal for an emergency fund is to have 3 to 6 months of salary or resources there. So Sister Beverly is correct that the $500 is a starting point, but you want to be able to handle things where if something happens, because most folks, when they lose a job or lose a source of income, it takes 3 to 6 months to replace it. So that should always be your final goal. So please see this $500 as an initial goal.
Thank you. All right, so we talk about that financial empowerment is a long-term goal here. So how do you know when you reach that plateau, when you've gotten there? So at that point, you're consistently saving, you're living on a budget, living within your means, you're committed to stewardship and charitable giving, you're balancing your checkbook, you're planning meals and shopping ahead, you're giving yourself permission for an occasional treat, you're setting financial goals, you're having your tax withholdings correct. You want to make sure, you know, some people like the big refund. You know, they think, oh, they're giving me back $2,000. No, that was your money in the beginning. That just means that you didn't have your estimated taxes, you know, where they should have been. Eliminating or reducing debts and expensive habits that we may have. Involving the whole family in your money discussion. That is so very important, so that everybody in the household, you know, should know kind of where we stand as far as the operating budget of the family. Next. All right, so I split that up for you, Deacon, so I think you've already covered. Did you cover this part? No, go ahead.
I've not covered this yet. Yes, this is the 4th principle. I'm sorry, this will be the 5th principle, actually, because we covered two of those last month, and that is to avoid unnecessary debt. First thing I want to point out to you is that there is a such thing as good debt and bad debt, and I'll define good debt is things that help you meet your goal. You have goals set up. Okay, there's nothing wrong with you going out and doing some things as long as it helps you meet your goal. But debt in general makes you a slave. You got to understand that whenever you go into debt, you are taking a risk. Now, sometimes the reward is greater than the risk, so you do it. But in general, debt makes you a slave. Proverbs 21:7 says, the rich ruleth over the poor, and the borrower is servant to the lender. The point behind that is before you go into debt, you should be thinking about those things. You know, the term impulse buying always bugged me, because because we treat money as if it's a treat, and it's really a tool. It's a tool used to help move us forward, to move the kingdom of God forward. People pray that the church will do this and then do that, and then they spend the money before they get there and say, the Lord will provide. Many times the Lord has provided, but we've gone into debt and we can't actually do the things we're called on to do. So understand that debt in general makes you a slave, and that you have to pay that money back. Second part of that is you need to pay what you owe. In this world of going in of bankruptcies and things like that, people believe that you can go out and borrow and then not pay folks back. Proverbs 37:21 says, "The wicked borrow and payeth not again." When I was a kid, there was an old saying that says, never compromise what's right and uphold your family name. And people need to understand that when you borrow money, you're actually putting your name out there. And to not pay back is to prove yourself untrustworthy, and that is not the Christian way. So the point I want to make here is that we want to make sure we understand the seriousness of borrowing. And we need to avoid unnecessary debt. You should only borrow with your long-term goals in mind. That's a very important point there. Thank you so much. Any questions, just let me know. Sister Beverly, you're on mute.
All right, so we're going to item 6, dealing with debt. So what are the right ways? What do we need to be considering as we know that there's debt present, some things that we should be doing? Next slide. Okay, there's a difference between debt and credit. So debt is money or something that you owe, while credit is your ability to borrow money or access goods or services with the understanding that you'll pay later. So that's credit, and then that's debt. So those are two different unique characteristics. Next. So how much debt is too much? Why does debt matter? Okay, it can, sorry, I had some background activity going. It can be evaluated by your debt to income ratios. Oftentimes we hear about the debt to income ratios. We've never really understood what they were. We might have been turned down for a loan saying that your debt to income ratios were not in a position to get the financing. So this simple calculation shows you how much of your income goes towards paying your debt, and is used by lenders in making credit and mortgage decisions. So debt to income guidelines. So as a renter, one of the things the material talked about considering, maintaining a debt to income ratio between 15 to 20% or less. So we'll do an example a little bit later so that you can see exactly what that means. So you want to maintain, if you're a renter, you don't want to have your ratios out of 15 to 20%. You don't want them to be any greater than that 20%. As a homeowner, you will have some additional things such as your, you could have PMI, mortgage insurance, you could have taxes and insurance all calculated. So they do the calculations a little differently if you're a homeowner. So you should consider maintaining a debt to income ratio of 28% or less for just the mortgage, which is the home loan, taxes, and the insurance. But they will consider your other household debts as well, your credit debt. So that gives you up to 36% or less in your ratios. Next screen. So how do you calculate this debt to income ratio? Once you've calculated what you spend each month on your debt payments and what you receive each month in income. So we'll start right there, because in that debt, you also have to include everything that's in your budget, you know, your monthly expenses, your rent, your mortgage, all of those things have to be included, your credit card payments, student loan payments, anything that you have to pay out that a lender will look at, and they will have access to your credit report, so you can't disguise anything, you know, so you might as well say, okay, before I go to the bank to get the car loan, let me be proactive in seeing what is my debt to income ratio? What are they going to be looking for? So that I don't have to go to 5 different car lots. I can go to the lot where I'm going to meet the requirements there. Some lenders have different ratios that they use. It's not all the same across the board. So you have those numbers, and once you have those, you need to calculate your debt to income ratio. So to calculate the ratio, you divide your monthly debt payments by your monthly income. So you're going to take your monthly debt payments and you're going to divide that by your monthly income. Then you multiply the results by 100, or if you know how to do percentage with what your calculator, then you don't have to do that. So here's our example below. So Sam's monthly debt payments total $1,540, and his monthly income totals $4,000. So we divide that $1,540 by the 4,000, and then we multiply by 100, or hit the percent sign, all the same. So at this point for Sam here, we got his 1,540 divided by the 4,000. So he ends up with a 38.5% debt to income. So if he's trying to if he's a renter, that's going to be an assessment high because it said you shouldn't go over 20%. So if he's looking to buy a home, then again, then that will get, he'll be too high even for some home loans. So I've seen lenders may tweak it up to about 39, 40 back in the day. So, but still, I wouldn't want to buy a home and have that much excess debt while I have a mortgage payment. Anybody have anything to share on that one, or any questions about how that's calculated? So you think you can go ahead and do your own calculations at some point? So all you have to do is take your income, take your debts. So you're going to divide, your monthly debt payments by your monthly income, and you'll be able to, be proactive and empower yourself and know why a lender may say no or why they did say yes. And you'll be able to look at your income and your debt, and you would want to do that too, if you would share money with someone, if they had an excessive debt to income ratio, and that may be why they're coming to you in the first place, but that would mean that's a higher risk getting your money back when someone has a higher debt to income ratio. Next.
That's a very good point that I hope everyone heard that and understood that. Many times you find yourself going out and applying for a loan or something like that, and you find out that you're paying a very high rate. And what's going on there is someone's looking at your credit scores and your debt to income ratio. They're seeing you as a risk, so they charge you more. So everyone who goes to a place doesn't get the same rate. And many times folks will say, well, they cheated me because they gave him 4%, but they charged me 8%. What that means, though, is that they see you as a larger risk, so they charge you more because people in your category, don't pay back as much. So you need to understand that by improving your debt to income ratio, improving your credit score, you prove to a lender that you're more reliable and dependable. So they will give you a lower rate because of that.
All right. So that's debt to income worksheet, and I think I have, Deacon Moore, did you put that one on the website? I don't know if you put that. That was a different attachment. So you can put that out there, and that's just a worksheet so that if you want to list out your debt and your income and be able to apply what we talked about as far as the debt to income ratios.
Let me go pull it up right quick here for you.
Sure, okay. Well, I'll send that to him because that's not the one. That's
okay.
dealing with the credit. We'll save that one, but yeah, we'll use that one later. But yeah, there's one, and as we go to the next page, and it's also in your book, but I was just going to show you. So we'll go to the next slide, and that'll be a shorter version of it there.
Oh, 1 second then.
All right.
That was the one you sent me there.
Right, so we'll use that one in just a few moments. Okay, So here it is in a miniature form. So you can kind of see, you know, you can follow that format of listing out your debts and your income and then doing the calculation. And on the other worksheet, it just gives you a place to list all your debts and your income and get the totals on that sheet. So I'll send that one over and he can post that one later. So this debt to income calculation, as we talked about, you just list your debt. You have a debt log in your books under that module 6. So you want to figure out your gross income that we talked about and then being able to look at all your expenses and get that calculation. And it's always better to estimate lower for the purposes, you know, of the two, so that when you get to the bank, you're in better situation and you didn't overestimate. It's always better to underestimate. Next slide. Okay, so we want to put this debt action plan together. Okay, I have this debt, and many of you, I hope, have your credit reports, and you kind of know. We looked at, talked a little bit about some issues or some options for debts and repayment of debts in one of our earlier sessions. But I put this little diagram here so that we can understand, like we talked about earlier, you're going to get different interest rates based on your credit. So as you can see, you can pay a higher interest rate, you know, so that's one option. So when you think about, I want to plan to repay my debt. So these are two different options. So we have interest rates on credit cards, mortgages, loans, and things like that. So that's one option at the top. So the two ways to reduce your debt is you can pay your smallest debts first, okay, which will be the diagram at the bottom, paying your smallest debts first. So you can have, say, 5 debts. Well, I'm going to knock out these first 5, get those out. So I'm down to number 2. I've already done 2. I'm feeling good about myself, because when you're able to at least do 1 or 2 of those, you're feeling like you're encouraged that you can continue the process. So then if you want to look at, you know, continuing that path, you can do so, but there's always the other route. You pay your highest interest rates first. So that would be that top display, which shows you the highest interest rate. So with that one, sometimes it takes a little bit longer maybe to pay off all the debt. So you may not get any gratifications, because it may be taking longer to pay off the debts with that highest interest rate before you see any accounts paid off. So you have to consider which one of those would be the best route for you, but there's pros and cons. And the biggest thing that I think would be the biggest difference is that if you're paying off that highest interest rate one first, you're going to save money in the long term, because you're going to be able to have lower interest on those other accounts that you're paying off. And that higher interest rate could be the very last one, and could have the highest balance on the other method. Okay. Can everybody hear me okay?
Yes.
Okay. All right. All right. So here's just kind of a demonstration when you want to compare your auto loan. So you're going to buy a car. So here's some things that you'll want to think about. First, you want to evaluate, you know, what are my options? So you evaluate the total cost, and you want to look at how much can you afford, and you want to be able to negotiate a deal. So what can I afford, and what options can I negotiate? So you want to go knowing what options you have. I wouldn't go there first without knowing what my credit score is. I would know that in advance. You may consider financing through a credit union or a bank, and you can have a one-on-one. But sometimes when you go directly to car lots, it can be like a meat factory. You know, they're all over you. You're making you nervous, and you know, it can be very intimidating sometimes. So always kind of know before you go, you know, how do I look? You know, how's my ratios? How's my credit? What things can I negotiate? Do they have any low interest rates? Are they offering any special financing? So kind of explore those things before you go out to start looking. And you always want to make sure that you review that loan contract in details before signing. Next. Okay, so many people have, I had clients in the past that would talk about wanting to do a debt settlement with a debt settlement company. And instead of, they might have had some old debts, they're trying to change some things. They say, oh, well, I'm just going to go to this debt settlement company I heard about on the radio. So what this debt settlement company, creditors oftentimes agree to accept less than a full payment on a debt that you owe. So what they do, they work with these debt settlement companies, and they would give that account to them. So these collectors, at that point, they will not hound you for the money anymore, and they technically cannot sue you if you're working with a debt management company. But there's some goods and bad on that. I wouldn't recommend that as a first resort. Payment of your debt is spread over time with a small amount paid each month. So if they're able to reach that settlement, it can sometimes take up to 2 to 4 years before a settlement is agreed. But in the meantime, in the background, you're paying additional late fees and you're paying penalties on that account that you are settling. So if you're selling 2 and 3 different accounts, so now you're paying additional fees and penalties on 2 or 3 different accounts. And again, you're paying additional monies that you don't have to. And there's not always a guarantee that the debt settlement company is going to be able to resolve your debt for less. So it's a high risk thing. A lot of people get in the mode, well, I know I can't really want to file bankruptcy, so I'm going to do the debt settlement option. I'm going to get rid of all this debt. I'm going to put them into one payment a month. Well, that sounds real good. Oh, I don't have to pay 5 people. I don't have to pay 1. But you have to realize that that settlement company is now charging a fee. They don't do that for free. So there is a fee involved. So they're going to get the buck of their fees up front in case you change your mind and stop paying them what you owe. So they're not worried about your credit. So they're not going to be making monthly payments in full to your creditors. And many times you may already have been late, but you're not the first priority for them. They are. So they want their money. So say if you give them $500. So if they have a fee of $900, well, that first $500 ain't going to go to your bills. It's going to go in their pockets, because in case you decide to change your mind, they want to make sure they recouped as much of their money as they could. And so once you have their fees paid off, then they'll take whatever money they've calculated that you should pay every month, and they'll pay a portion of that on your debts. And in many cases, it's not the full amount. In many cases, now you've already missed 3, 4, or 5 payments while waiting to, make sure you got their fees paid in full. So there's not a lot of good to that. I don't recommend that. That's just my personal opinion. You may have different options to maybe work with a credit union, somebody that can maybe help you do a consolidation loan that's valid, that pays off the other debts versus doing a debt settlement with a company. So again, what are some of those consequences of using a debt settlement service? They're very costly. You're paying more money in the end because you're paying additional late fees and you're damaging your credit. So anybody have any questions on the debt settlement and how that works? All right, next slide.
Let me add to that.
Sure.
I always believe there are certain things that are worth emphasis. And for those of you who are listening, Sister Beverly just made some great points there. I think one of the biggest issues we have is that we don't see the financial sectors of the world like everyone else does. She made a very good point there. Those companies are doing that to make money. You are not their priority. They're making, so don't assume they're doing you a favor. Those people are there to make money. Most people who make these commercials on TV, they sound nice and sincere in the commercial, but they are there to make money. And you have to be careful of those things before you step into something, because she's right. They will make sure they get paid first before you do anything at all. So if you do find yourself in need of a service like that, look for other options where you're not paying someone to do this for you, because they will take the buck of the money themselves and leave you in the same situation you were in at first.
Thank you. Okay, so there are some other ways to settle debts. Many of you might have heard of the cancellation of debt. That was something that came out a few years back. And so what a cancellation of debt, it occurs when a creditor relieves a debtor for a debt obligation. The debtor may be able to negotiate with a creditor directly for debt forgiveness. This can also be done by a debt relief program. And many times that's what they're doing in bankruptcy. They're doing settlements for you, but you're still having to repay the money. So how does debt cancellation work? What is that like? So a portion of the debt is forgiven by a creditor, okay? And the portion of the debt forgiven will be reported to you on a 1099-C form as taxable income in the year incurred. So what that means is that, okay, I'm going to settle this debt for I owe $3,000. As we look at the example on the bottom, I have a debt of $3,000. Now I was approved to cancel a whole $1,000. So now I'm excited. I'm going to save this, $1,000. I'm going to have to only pay this $2,000. So when you repay the $2,000 and not the $3,000, so that's a good thing, you're thinking, which is good. And I've seen people benefit from the debt cancellation because you can still pay the debt. You don't have to incur a bunch of lateness on your credit. So however, now that $1,000 is reported as income, on the 1099-C. So what it is, that 1099-C, that's anything like that gets reported directly to the federal government. So when you go to file your taxes, there's no hiding that. They already have that as well. They send that to the Internal Revenue Service to say, Ms. Jones had 5 debt cancellations this year. She was able to get rid of 5 of her debts. She paid them, and here's what our fee is. And sometimes you may still be paying on that debt, but you have to incur that fee in the year that you do the account or set that up. So what you can mean if you do 2 or 3 of those in a year, and now you got $5,000 worth of 1099-Cs, now Uncle Sam says, okay, we want our money on that $5,000. That gets added to your income, and that gets calculated in your total income for your adjusted gross income, and now that is taxable income to you, and there's no tax withheld. I don't know, you might have an option to ask them if they can withhold taxes on that. I'm not sure, but be sure of one thing, it will be reported as income to the federal government. Next slide. All right, so we're going to talk about understanding your credit report. So we're moving over to Module 7 in your books. Okay, so what is credit? So we talked a little bit about credit earlier. Credit is the ability to borrow money and repay it later. So I have a trivia question. Anybody can reach out and answer. Can you have credit available to use without having debt? Can you have credit available to use without having debt? Is that true or false? All right, Ms. Davis? True?
Yes.
That's very true. You can have credit without having debt, because you can have open line of credit and have 0 balances on them. Thank you. What? Okay. So how is credit used? So we've been talking about credit. So we know that's, any open accounts that we owe someone. So this credit is used to create your credit history. It compiles your credit reports. And it also is used in the calculations of your credit score. So that's how the credit is used. Okay, so we'll talk a little bit about poor credit scores and what it really does. People talk about the FICO score and, this credit score. So what is the real overall impact? So if you have a poor credit score, so here are many of the things that could be happening. It makes it harder to get a job and a security clearance for a job. So they do check your credit for many positions, and they want to make sure, especially if you're going into banking, brokering, financial brokering or something like that, they're going to be looking at your credit. Even for military positions, they're now looking at credit. So a poor credit makes it harder to purchase a home, even to get an apartment. You'll get higher insurance rates even if you get covered. Sometimes they're saying, no, if you have poor credit, you have to go to a different company because to them you're a higher risk. Also, you will have to pay lower deposits. You may have to pay lower deposits. You may have to pay, excuse me, when you go to get a utility with the utility companies, they're going to check your credit. And if you have poor credit, they're going to say you're going to have to pay a higher deposit, or you'll have to pay a deposit. Even with the cell phone company, they will say, oh, we checked your credit. Oh, you need to put $300 down because of poor credit. And someone that's standing next to you that has good credit puts down 0. So that poor credit, it can be an issue in a lot of ways. It can be an issue when you try to get a credit card, like Deacon will explain. You'll get a higher interest rate, even on a mortgage, things like that. So having poor credit and trying to be a consumer it can be very taxing. So if any of these would apply to you and you're in the market to maybe buy a home in the future, or look at maybe getting a one credit card and disposing all the others, and you want to just get a clean slate, then always start with, okay, what's going on with my credit and what I need to do to improve that credit now, so that in the future, a year from now, 2 years from now, I'm in a better position. So never be afraid to face what your credit is. Just know this is now, but this won't be my tomorrow. So take action today to always say, I'm gonna be proactive in taking care of my responsibilities. Next slide. So what happens to that negative information on your credit report? Anytime that you fail to pay a debt or have a collection account, all that will show up as negative information on your credit report. And so it stays on there for a specified period of time. And in many cases, it can be up to 7 years. So an account that you had 5, 6 years ago, you think, oh man, that should be out. But no, it stays on there. And in the past, I would have clients say, Ms. Beverly, I'm going to pay up all my collection accounts and I'm going to have good credit. No, it doesn't happen that way. Because you had an old account that was a bad account, and because you run pay it off, it does not, in the past, especially when I was in the mortgage business, they would not let you get any better, no points for that. Here recently, they have started maybe giving you just a small amount of points for paying off collections, because now they feel like, well, you did make an attempt and you did do it. You did pay it. But in the past, you got 0 points and it did not move the credit score. And oftentimes we get in the mindset, oh, I'm going to go ahead and do it now. I know I messed up 5 years ago, so now my credit's going to be automatically good. It doesn't happen that way. So bankruptcy can stay on your credit report for up to 10 years. Now, that's a long time. 10 years is a long time. Any civil suits and judgments can be reported on your credit report for 7 years until the statute of limitations have expired, whichever is longer. So you can see how anything of a negative is just going to stay there, and it's just going to hold you in a place where you can't get good interest rates, where you can't buy the home, where you can't get a good car payment and lower rates and things like that. So now, if this applies to anybody, don't be afraid. Just take the steps necessary and say, hey, this is today, and I'm going to have something different tomorrow. Next slide. So a little bit more on the negative information. Most consumer reporting companies are allowed to keep negative information about you in their files forever. They do this because there's no time limit on information, positive or negative, that a consumer reporting company may include in your credit report when you're applying for, such as a credit of $150,000 or more, life insurance with a face value of $150,000 or more, a job with an annual salary of $75,000 or more. So anything in that history, if these 3 things are relevant, could go back further into some of your credit history. So however, there is no time limit to the length of time that positive information can stay on your credit report. So that's some good news there as well. So that good positive information on your report can stay there, yeah, for a long period of time as well. So it's no time limit. Next slide. Okay, so people always wonder, okay, I got this credit score, so what does it mean? You know, got the score, don't, you know, what is that made up of? So this little pie chart here shows you that they take many things and make up that credit score. It's not just your payment history. However, payment history is a big component of it. So we'll go and we'll look at each part of it. So yeah, payment history, we'll start with the big green. So that makes up 35% of your credit score. So what that means, every time you make an on-time payment on an account every month, you're gaining more points. So those points make up 35% of your credit score. Moving on to the blue, new credit. So if you have a lot of old credit, which is good, and if you're not opening up a newer credit in the last 5 years, 2 to 5 years, then your new credit, you're not going to be getting many points for that every month because you haven't opened any new credit. You know, so some people, you know, change out, get different plans, get different rewards and bonus points and free trips, and may close some other ones that are paid off just to have a new one to add into that new credit, you know, for that mix. So new credits are new accounts. So if you don't have any new accounts, you do miss that 10%. But if you have a good payment history and the other components are good, then you're still in a good position. You don't have to run out and get new credit just to get that 10%. So moving to the red, the type of credit, that's 10%. So that 10% would be a mixture. What's your credit mix? So that would be, do you have mortgages? Do you have student loans? Do you have credit cards? Do you have a personal loan, car loan? They like to see a mix of credit. So if you just only have a mortgage only, then you don't have many points every month going towards types of credit because you just have one account open. So now if you have a mortgage and a credit card, now you have 2 types of credit. So you get points. So now you have a car payment, student loan, and that mortgage. So those types of credit gives you a percentage of your points every month. So the length of credit history, now that's where I fall in. I've been doing credit for many years, so I get a lot of percentage points, 15%. Yeah, I probably get that whole percentage because of the length of time I've had credit. All right, for you youngster, you might not get all 15%. You know, I don't know how they make that determination, but just know that the length of credit, the longer you have established accounts, whether paid or still open, that increases that length of credit on your credit score. And the amount owed. So the amount owed, and here's one we really want to pay a lot of attention to, because that amount owed, so we'll look at, you know, an example in just a second here, because that amount owed, and if you are maxing out on your credit accounts, say if you have a credit card of a $3,000 limit, and you have that kind of at $2,500, so you have really maxed out that account, meaning that you owe so much money at that point because you owe almost as much as account is valued at. So you don't want to max out an account because that will reduce the amount of points that you get because you owe so much. So they're looking for accounts where you owe under probably, I would say stay within 30% of what you approved for. So if you approve for $3,000, I wouldn't have more than $1,000 at any point, you know, on that account. But less is always better. It's always best to pay that account off every month if you're able to do that, and then you're able to have 0 owed. So the less that you owe, the more the amount owed percentage you'll get every single month in your credit score. Anybody have any questions about the FICO credit score?
Yes, ma'am.
Okay.
I have a question. So if you have a lot of, like you've applied for different credit cards and you've gotten all of those and they show up on your credit report, but you have a 0 balance on all of them, and they all were paid on time, no late fees or anything like that. How does that affect your credit report?
Well, if they just been sitting out there, you know, they just sit out there and they continue to give you, if it's a loan history account, say if something you've had up 5 years or more, that's going to give you that history, and that's going to be, you know, where you had the length of credit history. So that's going to keep that a percentage going into that account. Whether you should close that account, I've heard sometimes if you go in and close those accounts, then you might lose some points. But do you want to have that just, you know, some people just leave them there. I've got a few like that. Just leave them there. Don't pay, you know, don't owe them anything, but I just have them there. So I can't tell you for sure what points you will lose if you close them out. You know, that because it's going to now impact that length of credit history for one. It doesn't apply to anything as far as a payment history because you're not paying on it, amount owed, new credit. So it doesn't impact anything else other than, I think, that length of credit. And so from a lender perspective, if you're going to get a loan or buy a house, they say, oh, they have 5 accounts open, 0 balances. But at some point where they max those out, if they get in a hardship situation, when I was in banking, I've had to ask clients to close an account or 2 for that very reason, because they don't want to feel that temptation that may come on, and then you'll be in a different situation financially, you know, if you start using those accounts. I've had clients had to close 2 accounts right at the closing. The lender didn't want those accounts open. So then it's just depending on a lender and what you're going to be looking to do financially, or you're looking at any loans. And if you're not looking to really get a loan or anything or buy a house, you know, I don't think it has too much negative impact. But I'll let my deacon brother see if he has any additional information to share on that.
Okay.
Yes, don't mind at all sharing on that. And as always, I'm of the opinion that whenever you use credit or get a new credit card, you should always do it responsibly. And the reason why is because many of these sections in this pie chart that you see in front of you can work against each other. Even if you have a credit card that you've never used, when you apply for a loan, that company is going to assume a minimum payment for that. So if you have a credit limit there of $5,000 as an example, and you owe no money, when they actually go in there to check out your debt to income ratio, they will apply a factor there. So even with a 0 balance, that credit card can hurt you. Of course, it helps you when it comes to your length of your credit history and things like that. So I'm of the opinion that it is never a good idea to have a large number of credit cards. I think I mentioned to you all before, I think I have 3, but I use those 3 because of the businesses that I have. If I didn't have those businesses, I'd have less cards, because I don't want that credit out there, because a bank understands that any amount of credit you have, all you have to do one day is to use it, and then it's going to expand your debt. So my point, and you know, I'm always kind of teasing Miss Lisa about this, but for some reason every year in December, you know, these companies will give you, 10% off if you apply for a credit card. And again, people don't do things because they're nice. They do it because they make money off of that. They understand that if you have a credit card, you're more inclined to spend on it. So come back to the main point there. You should try to avoid having lots of cards. If you want to increase your limit on one card you have, that makes sense. But yes, having a large number of cards can actually damage your credit report, because as you apply for loans, they assume that each of those cards, used or not, will always have a minimum payment.
Very good point. And so maybe, a strategy might be to, if you want to close 1 or 2, maybe you do them, one kind of, if you want to spread them out. If you're not going to be doing a lot with your credit, you can close them, and the impact that will have in your credit score won't be as relevant if you're not really trying to go and make a purchase on something.
Yes.
All right, next slide.
Oh, sorry, hang on, went too fast.
Okay, so credit utilization. So we're talking back about, that account, say $5,000 that we just talked about. So if you charge up to $3,500 on that account, so that utilization rate, that'll be 70%. So to any lender, they're looking at you and saying, oh, they owe so much on that one account. 70% is just way too high. So I always try to keep your utilization rate, down 20-30% on any account that you have. And if you can, pay them off every month, and then that way you don't have to worry about, that utilization rate at all. Next slide. And by the way, we are scheduled to 11:30, so I don't know whether you saw that when you signed in this morning. But yeah, so it's about 10 after 11 or so. All right, so we want to start talking about reviewing your credit reports. So what you do. So many of you hopefully have already pulled your credit reports. And it's always a good thing to at least pull that 2 to 3 times a year. Things change. Identity theft is very prevalent and very high. There's so many scams and schemes going on. So you want to make sure there's nothing going on in your credit report that you're not aware of. So the only way to do that is to have a copy.
Ms. Deb, can I hop in here 1 second? Because a question was asked of me this week about that. And someone asked the question, if pulling your credit actually hurts your credit. And I'm not a credit expert, but I kind of understand how this works there. There are things called hard pulls and soft pulls. A hard pull is typically what a company does for you. So if you're applying for credit and you apply at a certain store, they'll do what's called a hard pull, which is seen by your credit agencies as an inquiry to receive credit. That can lower your score if that's done quite a bit. On the other hand, if you actually have these services where you check your own credit, that's more of a soft pull. That doesn't hurt your credit there. I was telling this person when they called this week that I actually pull my credit once a month just to know what's going on there. And I use Credit Karma. I'm not saying Credit Karma is the one you should use. There's several out there, but me pulling my own credit does not hurt me at all. Someone else, some agency pulling it to give me credit does hurt.
Okay. Thank you. Yeah, we got a couple of slides coming up that will kind of talk about that same thing. Very good. Thank you so much. So what you want to do is start by getting your free credit copies. And a lot of times, I have clients that like to use that Credit Karma. And they say, Ms. Beverly, my credit score on Credit Karma is a 650. I'm getting there. When they get to the place of business, okay, Credit Karma didn't match up with the lender. And sometimes it may be a little bit different, but it gives you a good range. And Credit Karma is a good source to use just to be able to have that flexibility to peep in every month. And they send you alerts and things like that as well. So you want to read through your credit report carefully using this checklist. And this is in your book. You're reviewing your credit report and just want to make sure that things are correct and as they should be. Next slide. So while you're reviewing your credit report, you want to look for paid accounts, because they're going to stay on there. I think that's on the wrong place. But yeah, any paid accounts that you paid off will stay on the credit report for up to 10 years. So which is a good thing because that lets people know that you did a great job paying off that account. So here we are with the soft inquiries and the hard inquiries, or credit pulls. So basically, those soft inquiries are usually initiated by others, like companies making promotional offers. Those are soft inquiries too. Like if you get an offer in the mail, that will show up. Also occur when you check your own credit or when you use credit monitoring services. So again, those are the soft inquiries speaking of. So those don't have really any impact on your credit, okay? But those hard inquiries are the results of applying for credit or financing as a result of a collection company. So even collection companies would go and pull your credit. If an account was sold to a collection agency, they have the right to pull your credit. So these become hard inquiries. So they will report on your credit report, as well as a soft one. So if you have a copy of your credit report that we discussed pulling, you'll see at the end, soft inquiries and hard inquiries. So you should have that information. So this will include the names of businesses that have reviewed your credit report over the last 2 years. So I thought that was kind of interesting. It stays on there a very long time. So it stays on there 23 months. So as a lender, if they see that you have a lot of hard inquiries, if you're going to buy their house, so you're going to want to compete for that mortgage naturally. But for a mortgage, they say, and I hope this is true, that you can shop around and then 3 or 4 inquiries from banks or mortgage companies will only appear as one hard inquiry as far as the hits to your credit. So you won't get a lot of negative by shopping for a mortgage. Okay, but as a lender, and if they look at that, oh, they've applying for 10 different credit cards in the last month or so. So sometimes they will be kind of assessing the risk level of a particular client to see they must be having really hard times. They applied for 5 different credit cards. So they may look at that as can be risky sometimes in your credit file. So you're protected by the Fair Credit Reporting Act, which is a federal agency, and that protects you for the accuracy of your file and the fairness, privacy information, and so they make sure the Consumer Reporting Agency has accurate information. There's some laws that protect you, and that's a good thing. So next slide.
Yeah, I give a quick example of that. As Sister Bev said, if you were out shopping for a house and within a period of time, you actually applied through several banks, they would only see that, even though you may have applied at 5 banks, they will only see that as one inquiry. But if you were out shopping for a car and you went to 5 dealerships, they would see that as 5 inquiries, and that would hurt you. So my word of wisdom for that is that whenever I go out to get a car loan, I always take my credit report with me and say, what can you give me if my credit score is this? And that way then, only once I found the car I want, do I let them submit the credit report for cars, because houses are different from everything else. So say again, if you're applying for a house, you can actually shop around with several banks. If you're applying for a car, you ought to wait until you actually have the car you want to actually apply. You're on mute, Miss Beverly.
There I am. Okay, so reviewing your credit report continued. So when you're reviewing your credit report, you want to check that it contains only items about you. So you should have your report. So go down through that, make checks or highlight any information that is not yours. You be sure to look for information that is inaccurate or incomplete. So that's kind of your assignment. You want to make sure you're taking responsibilities. I have my report now. Are there any errors? Can I dispute some things, or is everything as it should be? So some common errors on a credit report are identity errors, such as your wrong name or phone number that's not correct, or an address that you never lived at. Accounts belonging to another person, that was person, not peon, with the same or a similar name as yours. Incorrect accounts resulting from identity theft. Closed accounts reported as open. You're reported as the owner of the account when you're actually just an authorized user. Accounts that are incorrectly reported as late or delinquent. Incorrect date of last payments, date open, or date of the first delinquency. So all that information is there. So what you want to do, if you see anything that's not correct, then that's when you will want to dispute to have those things removed from your report. Accounts with an incorrect current balance, especially, and accounts with an incorrect credit limit. So all those parts will be part of that credit report that you're looking at. So if any of those numbers and information is not accurate, then you have an option to have that updated and corrected on your report. So you have the right to dispute items on your credit report. All disputes must be addressed within 30 days. Disputed accounts can be removed by the credit reporting agency as well as the creditor. However, please note, unaddressed disputes can be removed after 30 days under the Fair Credit Reporting Act. And that one's really important because if you go to dispute something and there was a company 10 years ago and they've gone out of business and they reported something negative on your account, and once they do the dispute process, if they can't prove that you owe that account, they will have to take that off your credit. And that's what we're covered under the Fair Credit Reporting Act. So if you see anything that doesn't look correct, be sure to take that dispute option and kind of, you know, explore that and see if there's any way you can go ahead and start clearing up your credit report. Next slide. Okay, disputing errors on your credit report. So to correct errors, it can help to contact both the credit reporting company, so if that's Experian, and the source of the mistake. So you would want to contact both of them, you know, to go ahead and start that conversation if there's something wrong, if you have documentation to prove. But after any dispute that's resolved, be sure to keep all your documentation, have a file so that if something comes back later or if it reappears on your credit once it was disputed to be removed, then you have your document available to, you know, to prove that that should have been off your credit. You may file your dispute online, by phone, or by mail. So you have 3 options to dispute those. You can explain the error and what you want changed. So you have that option to clearly identify each mistake separately. You can state the facts, explain why you're disputing the information, and request that it be removed or corrected. And if you mail your dispute letter, send it by certified mail, return receipt requested, and also be sure to enclose a copy of the portion of your report that contains the disputed items and circle or highlight that disputed item. So that's some tips on that, and you should have some information in your notebook there about dispute letters and what to include, and even with the online options for credit reports, you should be able to dispute online as well. Next slide. Okay, so getting and keeping a good credit history. We've talked a lot about the bad things with credit, so we want to talk about, you know, we want to keep good credit history. So what you want to do, so you want to first identify a strategy for improving and maintaining credit that works for you. So first thing, let's clear up anything that shouldn't be there. Then you want to implement strategies to monitor how your credit has improved. And once you've done with your first strategy, pick a new one and keep practicing. So the list on the left will give you a lot of details about all the processes you want to go through so that you're starting to rebuild and improve credit. And I think, Deacon Moore, wasn't that second slide that you pulled up?
Yes, you want to show it now?
Yes, sir. Oh, that was about reviewing the credit report. So you can take that one down. Yeah, so that one's in the book too. But you'll have a bigger copy of what was displayed just a moment ago on the steps to improving the credit that should be in your book there. You're getting pretty good with that. Thank you. Next slide. Okay, so we're almost getting to the end. So here's a tool. What do you do when debt collectors call? You know, I always tell people not answer the call. You know, here's some steps of what you should do. If you have questions about that debt when they call, do not send money or even acknowledge the debt the first time you're contacted, and here's why. You want to make sure you actually owe the debt, and you want to make sure that the individual that's contacting you really has authority to collect the debt. So oftentimes if you owe J.C. Penney's and they just wrote their account off, they sold it to a collection agency. So you didn't pay pennies, now they sold their account. So now they sold it to John Smith Collection. So now John Smith would start calling you about the debt that you owe to J.C. Penney's. but you want to make sure that John Smith has authority to do that. You want to find out, listen to what they say, but then take that information and verify with the collector that you might be owed initially. Also ask for the name, number, and address for the debt collector and request information about the debt in writing. So they'll call you back. Don't worry. Debt collectors, that's what they do all day, trying to collect on debts. And they get money and fees for the accounts they're able to collect on. So they follow through quite regularly. So they will call you back, but don't be intimidated on that first call that you have to do a settlement or you have to do anything. Make sure that that's an account that you really owe and that you have all the detail there available to you. So if you're sued by a debt collector, be sure to respond to your court document. So if you get sued, don't just say, hey, I'm just not going to court. No, you want to follow through if someone gets to that point where they want to take you to court for that debt. Next slide. All right, so that's all the information about the credit report, and I want to review those. So anybody have any questions about credit reports, anything they need to do on it, any way they need any additional help or resources, or anything anybody want to share, good, bad, or whatever, about the credit reports and anything else we've talked about today? Any questions?
I have a question. To get your score
Mm-hmm.
From your credit report, what is the cost? Do we have to pay for each one that we request?
Yeah, you would have to pay for that. And sometimes you can get with different agencies, Kermit Karma. They have a score, but it's not always 100% as what a bank would have. But if you go back through that experience, they'll let you get the score, but you have to pay a fee. Some agencies have where you pay a one fee, you can get your score so many times a year. Yeah, but for the score, normally you do have to pay a fee. I've not been able to see where you can get that one free unless you go to a bank or something and you've applied for a loan. They will then disclose that information to you. But normally you do have to. Has anybody else had any different experience with getting a score, an accurate score for free?
I've always used Credit Karma. I agree with you. It isn't always exact, but it's close enough, and it's free. So I use that. I also know there are many credit cards, and I haven't done this, but I've seen the commercials where they say if you use this credit card, you can get a free FICO score. I'm not a big fan of paying for anything I can get for free. So from what I understand, every time I've looked at my Credit Karma score, it is always lower than what the bank shows me. So I just know that if I look good on Credit Karma, I look good everywhere else, and it's free. And free just works for me.
Right. Yeah, well, I saw Experian charges $14.95, but that's a monthly charge. It's not a one-time charge.
Yeah, you wouldn't want to incur that kind of fee. But like I said, Credit Karma is not bad. They have other tools with the thing about Credit Karma. If you're not astute enough to know not to take all those offers, they have a lot of offers they want to try to help people with getting new accounts set up. So long as you're smart enough to know that, hey, I'm not going to take all those accounts that they're offering. But they're a good service. And another thing that Experian has, you may have heard about it on TV, it's called Experian Boost. And that's a free service right now. And I saw that last night. And one of the things, I have a client I was working with to get her rent payment that she's paying every month added to her credit report because she has no credit. So they will allow you to get 12 months up to 2 years worth of your rent payment, add that to your credit report. They will also allow you to do that for utility companies. So there's some good things about that because that helps build some history, and it helps with the payment, showing that you paid on time. And even the landlords will be the one to report every month, Ms. Jones paid on time this month. And every time that landlord responds, that goes in that credit file for that client to give them some credit. So Experian Boost is something, it's relatively new. I know it's been out there at least a year, but just this month I've seen it for free. Normally there's a fee for it, but if someone's interested in adding some accounts to their credit because they have margin of credit, or need a credit score, or need a credit history, or some activities, you can look at adding good accounts right now to your credit report for free with Experian. Now that's not going to roll over to TransUnion and Equifax, but it is with, you know, just that one agency. Any other questions?
You know, I'm of the mindset of always using the information. For me, it doesn't matter who is trying to offer me credit. If I don't need the credit, I don't get it. So when I go to Credit Karma as an example, I'm not tempted because I don't, you know, they're saying use this card to improve your credit. I just say to myself right now, I don't need a card, so I don't get the credit. And if we keep that mindset always, if I don't need it, just don't get it. Because remember, as we said in that biblical principle, that you know, the borrower is slave to the lender. So if you don't need it, it doesn't matter what they say, don't get it.
Okay, good point. Very good point. All right, so next we're going to talk about our disaster checklist, and so this to me is a real important tool, and because we need to really be in the habit of knowing exactly what's going on. So this is a tool, and hopefully you all have a copy of this, and it's just a two-page handout, a flyer, and it just lists your account information. So that if something happens to you, especially if you live alone, someone else knows what's going on. They know about who to call about the mortgage, who to call about the car loan, you know, what are the utilities, what utilities you have. So it's just a little checklist kind of thing so that it's available and so that you know exactly what's going on, you know what things are, you know how to contact people, but not having a plan in place that really can sometimes be a little confusing at the wrong time. So you can have an emergency, a situation that's happened, and all of a sudden you don't have all that detail available to you. And I'll share something else with you real quickly. Hold on one second. One of the things me and Sister Pat did years ago with the senior adults, one of the things that we know, we had a lot of seniors that were living by themselves. And one of the tools, you know, I said, well, if I go over to see Sister Bosley, I can go over and visit with her. But if she has an emergency while I'm there, I can't do anything. I don't know her doctor. I don't know her preferred hospital. I don't know what medication she's taking. So one of the things that we did, probably, Pat, maybe 15, 20 years ago, we put together a binder. And so while I've been off this last couple of weeks, I've been working on my binder. And in the binder, something just happened to Beverly. Does she have long-term care insurance? Does she have short-term disability? What insurance policies does she have? You know, what's the retirement plan? You know, because everything is in the book. And I've gone through this week and I've called companies. So I've tapped my book. So I have a disability insurance, cancer policy, long-term care, retirement plans, home warranties, car insurance, homeowners insurance. Because for me, I like it all in one place. So this binder sits in my office. My husband knows where it is. And my children will know soon because you just never know what position that you're going to be in. So we put together a book for the seniors. We put the tabs in place. We offered service to kind of help them gather documents because when you go to help someone that needs the help, sometimes they may not be responsive and can't tell you all this information. And the other part of that, the fire department did provide tubes that you put in the refrigerator so that you can put down your medical conditions, what you're allergic to, who's your doctor, what hospital you prefer. And that tube was placed in the refrigerator. And on the front of the refrigerator was a little magnet. So the fire department would check there, or the paramedics say, oh, they have a tube. They look in the refrigerator and they take that tube out and it would give very good medical information as to how to assist that person that's in need. So this was a good exercise, and we may do it again with the seniors because so many seniors are living alone, and we can't assist, and we don't know what we don't know, but at least they can have a book handy so that someone would know, hey, they have a book somewhere, we're looking for the book, and they might have a place they keep that book so that we'll be able to assist them with some, an emergency situation. Any questions on that? Pat, you still have your book? I don't see Pat.
Yes,
Okay.
and I need to update mine, and I think it's a good idea to have that again.
Right.
To do that again. I think a lot of people could benefit from it.
Okay. All right. So we're looking at maybe doing that again, just as a service to be able to help.
Right.
Okay. Anybody have anything else? I guess we need to talk about our next session, when that would be. Any recommendations or anybody have any feel for that? 2 weeks, 3 weeks? We could move it out to a month. Okay. So, Deacon Moore, what you have any recommendations?
I'm with you, sister.
Okay. So then we'll talk, me and Deacon Moore will get together and talk about the next bit of information that we want to share. But in the meantime, if you have any questions about anything that we've covered in any of our sessions, please be sure to feel free to reach out to us. We'll be glad to answer any questions that we're able to answer, because this is for us to learn and to be able to be empowered so that we make some good sound financial decisions. All right, so that concludes our session for today. So we've got through all of the material. Thank you, Deacon Moore. I know he said, don't worry about getting through it, but we did a great job getting through everything today. So thank you all for attending, and we'll look forward to the next time. We'll post that out on Facebook, and it will be announced also on our church website, and our pastor will announce it as well.
All right.
Does anybody want another session? My husband said in the background. Oh, yeah, I see some head shakes, so yeah. Okay, well, we'll be in touch soon. Take care.
All right, then let's close that in prayer.
Okay.
Hey, Brother Paul, since you're back there hiding from us, why don't you close us out in prayer, brother? Brother Paul?
Yeah, sure. Father God, we thank you for giving us the opportunity to get this information this morning. We thank you for all that you do. We thank you for keeping us safe from the coronavirus. We ask that you continue to do that. That be your will. We ask that you give everybody listening the power, strength, wisdom, and will to understand what they've heard and try to implement it in their daily lives, be all they can be, debt-free. We just thank you, Lord, for all that you do for us. We thank you in the name of your Son, Jesus Christ. Amen.